Hello, everybody, and welcome to the latest webinar that we've got for Fair Tax Week. This one is focusing on tax justice perspectives across Europe. We've got a cracking lineup for you today, speakers from all across Europe who will talk about what's hot in their particular locality, but also provide us some thoughts on where Europe is going or where Europe should be going more generally. I'm Paul Monaghan. I'm the Chief Executive of the Fair Tax Foundation. I'll be chairing today, and I'll also be offering a very brief UK perspective, given that is where Fair Tax Foundation is based. This event is one of the many organised for Fair Tax Week, which runs June 8th to 18th. And like all good weeks, we even have a hashtag, and that is hashtag Fair Tax Week. Nothing too complex. We're not overly complex here. So feel free to follow that and use that if you want to find out what's going on. And basically, Fair Tax Week seeks to recognise businesses and organisations that are proud to promote responsible tax conduct. And we try to celebrate all the good things that corporation tax and other taxes pay for. So today we're going to be joined by Christian from Ørsted, who's based in Denmark, but who very much has a global perspective. Ørsted are one of about 250 trading businesses that now have a fair tax mark, who between them employ about 250,000 people and pay something like US dollars 1.4 billion corporation tax a year, and that's cash taxes paid, not total accounts accruals in the reporting accounts, cash taxes paid, real cash. We're also going to have Peter from Tax Justice Norway. Peter's kindly stepped in at the last second for Sigrid, who can no longer join us, but Peter's an accomplished author and more than able to join us on this. Then we've got Christoph from Tax Justice Germany. Christoph is a very, very impressive individual, I must say, whenever I've interacted with him in various Tax Justice Europe events. Very on the dot, on the ball. So this will be great to hear from him. And then we've got Lorena from CSR Europe, who's based in Brussels, but again, very much a European perspective. And Lorena's going to be trying to knit together all their work, whether it's tax or climate change, etc. And they're doing some really visionary, bold stuff with ourselves and some others, which I'm sure she will talk to. So just before I hand over to Christian, a couple of words about the UK. This is the UK bit. The UK is a weird, schizophrenic nation on tax. I don't know any other way to say it. I mean, at one level, London is the home of socially responsible investment. There's probably more socially responsible investment industry in London than anywhere in the world. And yet, that same city is also a global hub for dirty money, as we've just seen with the oligarchs who are now being rooted out there post the invasion of Ukraine. It's both of those cities at the same time. The UK both suffers from profit shifting by multinationals, probably to losing out about 17 billion UK pounds a year, just due to profit shifting every year. And yet the UK is also an enabler of tax avoidance through its network of crown dependencies in overseas territories, such as the Caymans. And so it both suffers from and enables tax avoidance in the same country to an enormous extent. But broadly, and I think one of the things that may come out today is which of us see the glass as being half full or glass half empty. We tend to be quite a glass half full type of organisation. And a couple of things I would talk to which are positives. One is that as of April, the UK is no longer aspiring to have the lowest headline rate of corporation tax amongst the world's G20 nations. Previously, it was competing with Saudi Arabia and Russia to have the lowest headline rates. That's no longer happening. We're now middling for the G7. And I think that's quite progressive in terms of positioning. Secondly, the UK has agreed to support the OECD's global minimum tax and actually to gold plate it in a few areas. So I think that, again, from our perspective, that would be positive. And unfortunately, just yesterday, we lost a vote in our legislature, which would have required, very narrowly, the vote was lost, that would have required henceforth all businesses engaged in public procurement to have to produce a tax report describing how much income, profits and tax was paid in the UK if they wanted to secure further public procurement contracts. It was lost about 280 to 240 just yesterday, but we're quite hopeful that that can come back to Parliament and be won in the not too distant future. So that's me racing through everything, and I'm going to hand straight over to Christoph. I'm looking forward to what he's and the others have got to say.
Well, Thank you for that introduction, Paul. And hi, everyone. I hope you're enjoying the Fair Tax Week and the many exciting discussions going on throughout the week. My ambition today was to provide you a bit of a, if you will, corporate perspective on the responsible tax agenda and why it matters to a big corporate such as ourselves. And ahead of actually jumping right into that discussion on responsible tax, I thought it would be helpful to give you a little bit of background and context on Ørsted, as I think that would set the scene quite nicely for why we as a company have decided to be a leading player in the responsible tax dialogue. Today, we are a global renewable energy company headquartered out of Copenhagen in Denmark, but we haven't always been particularly green or particularly sustainable or particularly global. We changed our name back in 2017 to Ørsted. This name change was in honor of the Danish scientist Hans Christian Ørsted, who discovered electromagnetism, the technology we today use in generation of clean energy from our wind turbines. Prior to our name change, we were called Dong Energy. Admittedly, that name has an unfortunate connotation in the English language, but really it was short for Danish natural oil and gas, which pretty much tells the story of what the company was prior to our transformation. In 2006, our production mix was roughly 85% fossil fuel based and thereby 15% renewable energy. And most of our fossil fuels came from coal, the most polluting source possible, really. In addition, we had oil and gas production and exploration assets in the North Sea. We made 88% of our earnings in Denmark and only 12% from international business, and that again was mainly UK and Norwegian oil activities. We were at the time one of the most coal-intensive companies in Europe, and we accounted by ourselves for a third of Denmark's national emissions. And at the time, our growth strategy was to expand in coal, oil, and gas activities in Northwestern Europe. Thankfully, we recognized a need for change around 2007, 2008. And we set an ambition at that time that by 2040, 85% of our production should come from renewable energy sources and only 15% from fossil fuels. Thankfully, through sheer determination, we managed to get ahead of that target by quite a margin. In 2019, we hit the target of 85% of our production coming from renewables, and thereby we reached our target 21 years ahead of schedule. We have decreased our carbon emissions by 86% through 2007 to 2020. And at the same time, we've more than doubled our operating profit, and our share of profit coming from production and sale of renewable energy is now up to 98% of total profits of the company. By 2025, our own energy generation and operations will be carbon neutral, and by 2040, our supply chain will be carbon neutral. So we've really gone from being a very fossil fuel intensive company to being a renewable energy company and gone through quite the transformation in the last 15 years or so. We've also globalized our business. Prior to this transformation, we made almost all of our money in Denmark. Today, more than 90% of our earnings are coming from outside of Denmark. So in addition to betting big on new technology and transforming the company's operational model, we've also gone global. With this transformation that we went through, came an increased focus on sustainability across everything that we do. As a company, we set an ambition that we want to be a catalyst for positive change. And that applies not only in tackling the climate crisis, but also in all aspects of society that our business impacts. And as a global company that thankfully has significant earnings and also make very significant investments, tax is an inevitable part of this obligation and part of the social contract we enter into when we develop and construct and operate our assets. As everything else we do as a company, we are committed to ensuring that our tax practices are both responsible, prudent, and long-term sustainable. That is first and foremost because we believe it's the right thing to do, but a responsible approach to tax is critical for a company such as ours in a number of ways. When we are awarded rights to develop, construct, and operate critical infrastructure in a country, a state granting us those rights must be able to put trust in us to not only deliver the project and the power generation that comes with it, but also for us to act as a responsible corporate citizen. Part of that contract, if you will, with the government is that we will timely pay the correct amount of tax on the profits we generate in that country. By focusing and having a tax policy in place that offers transparency on how we as a company approach taxes, and by being transparent in our reporting on taxes, we can help hopefully instill that trust in governments, which places an even bigger emphasis on responsible tax practices for companies such as us that ultimately are reliant on governments feeling comfortable in awarding us a particular and potential quite valuable set of rights to construct infrastructure assets. We also, as part of our tax policy commitments, we engage in public debate around tax policy and tax regulations. As a green company, our focus is very much on how tax policy can help support and nurture the green transformation. And as part of that exercise, we engage with governments, international bodies, industry bodies, politicians, and other policymakers to help guide them in how tax policy and tax regulation can be an enabler for the green transformation. By acting responsibly and acting as a prudent taxpayer, our voice in that debate ultimately carries a lot more weight, and ultimately our impact is bigger through having that trust from the community around us and our stakeholders around us that we offer a balanced and responsible view on these matters. So we certainly also see responsible tax benefits being an enabler of the advocacy work we do. And in the last decade or so, and even more so in the last couple of years, we have experienced an increasing both internal and external pressure in respect of tax transparency and responsible tax. Employees in the company have an expectation that we pay the tax that we are required to do. Investors require much more transparency on tax payments, tax governance frameworks, and ensuring that we pay the right amount of tax at the right time, at the right place. By being ahead of the curve almost in some of these areas, I think it's fair to say we've been able to both support talent attraction and retention in the company, as well as attracting and retaining investors, and at times also avoided some of the more tricky questions some of our peers have perhaps faced over the years. One of the continuous issues I think we faced is how do you demonstrate that you walk the walk and talk the talk when it comes to responsible tax? You will see also through various initiatives such as the UK requirement to have a public tax strategy, that a lot of companies will have a tax strategy or tax policy in place that's publicly available to everybody on the website. But how do you actually demonstrate that you comply with it? The general public probably doesn't take much notice of the tax section in your annual report or a tax report you publish, and even more sophisticated investors, governments, or your own employees might not either. So for us, it was that dilemma of how do we actually put it out there, what we do in the area of responsible tax. And that also, in a way, led us to say, well, should we be the first Danish company to go for the fair tax mark? It was a fairly new standard when we applied for it, the international standard. But having this independent certification that we meet a certain standard in tax practices was, at the end of the day, what led us to pursue the fair tax mark, because it is an objective standard that would enable us to quickly and concisely convey the argument that we at least need a certain set of standard. And that, of course, goes both in discussions with governments, but also investors, employees, policymakers, etc., that we indeed can be trusted as a responsible taxpayer. And when we say we act responsibly, there's also a certain evidence to support that. In addition, I would say this whole initiative we see in the corporate world of companies more on a voluntary basis pursuing responsible tax practices and disclosures above and beyond what's required by law in most jurisdictions is also an attractive element to us. Gaining a seat at the table with a group of like-minded peer companies that are committed to responsible tax offers us a great opportunity for sparring and for networking opportunities to continue for us to progress this agenda. And of course, if you want to be a leader in this area, it's only right that you engage with like-minded companies, not only on what is the expectation today, but also what is the expectation in 3 to 5 years. And lastly, I would say that by getting the fair tax mark as a large Danish company and as a large European company, we hope that we can inspire other businesses to also up the ante in the area of responsible tax. Closing the gap on tax avoidance is increasingly needed with all the issues faced by society today. So hopefully by moving forward and being a leader on this, we can inspire a sense of responsibility also with other Danish companies and other companies that we either compete with or are complementary with. And with that, I will hand it back to you, Paul. Many thanks for the opportunity to be a part of this fantastic initiative.
Thank you, Christian. At Fair Tax Foundation, we're not allowed to have favourites amongst our Fair Tax Mark accredited businesses, but if we did, Ørsted would be one of them, but we don't, so we don't. I'm now going to hand over to Peter. Quick reminder, or I should have said this at the outset actually, if you've got any questions, please make sure that you stick them in there, and then we can pick them all up at the end. We'll log in and we can see them, and then they'll all go live once the speeches are finished. Right, over to Peter, please, and can you please unmute?
Thanks. Can you hear me? And can you see the slides as well? Perfect. Thank you so much for inviting Tax Justice Norway to give a brief update and some perspectives from Norway. My name is Peter Ringstad. I'm the Policy Director at Tax Justice Norway. Tax Justice Norway is a part of the Tax Justice Network sort of family. We're a member of the Global Alliance for Tax Justice. When we talk about tax justice, from our perspective, we take a sort of societal approach, and a foundation for a just tax system is that you can actually have a tax base that is legible from the perspective of tax authorities, which means that you actually need to see who are what are the incomes that are supposed to be taxed in a country, what is the wealth, what are the sort of government, the companies who are supposed to be taxed where, and this is the background for what's now quite well known, the ABCs of tax justice, which is a core of what we do also in our work, which is automatic exchange of information between tax authorities, beneficial ownership information on companies, and country-by-country reporting. These are vital sources of information in order to actually be able to see who are supposed to be taxed. So before you can sort of discuss what rates of tax should be applied where, you actually need to know what companies are supposed to be taxed where. So I just wanted to bring up a few perspectives. I'll come back to these transparency initiatives, but if we're talking about more material tax rules, Norway is sometimes jokingly referred to as the most obedient EU member, even though we're actually not a member of the European Union. But we do implement EU legislation often much more sort of obediently than a lot of EU members. So on major developments like the OECD Pillar 2, we have just now had the government propose implementation, which is basically the EU approach to Pillar 2 and the EU implementation of Pillar 2. We also are we have on public country by country reporting, we don't have a proposal yet, but we do know that the government tends to sort of wait and see the outcome of EU processes before before proposing Norwegian legislation. So we're hoping and we're working to sort of propose a much better approach. We see that the EU proposed country by country reporting has a lot of loopholes and sort of outcomes of political processes in Brussels that doesn't make sense from our perspective that Norway should implement here. So we are very excited about seeing, for instance, what is going on in Australia with country by country reporting, and hopefully we can inspire Norwegian policymakers and politicians to actually be brave enough to take that as a starting point. Also worth mentioning is that we have quite good basis on legal ownership of companies in Norway. So every shareholder is basically publicly available information of any Norwegian company. The problem is that it's often, before you have this information available in the public domain, it's often outdated, and it's based on just once a year reporting. There is a decision to make a public government register that is fully updated and which would encompass absolutely all shareholder information, so legal ownership information of companies. But this is the timeline of that is years into the future. And I think it would be perhaps a better way to just decide by law that this should be provided by companies, and then have systems for reporting it provided by private actors. But this is something that it's not a TGN position, so we could discuss that. And I wanted to also to say a little bit about the beneficial ownership registry process in Norway, because this is something that we have focused on a lot. Norway is right now one of the last European countries to not have implemented a beneficial ownership registry, quite surprisingly, actually. I believe it's Norway, Italy, Hungary, and Lithuania or something who actually don't have any register in place. Even though we actually had a parliament decision to implement, to get a register all the way back to 2015. It's been a very long process. And right now the situation is that we had a planned launch 1st of January of this year, and that planned launch was in the middle of Christmas decided to be indefinitely postponed after the European Court of Justice verdict in November of last year. This is something that Tax Justice Network is focused a lot on, is trying to, first of all, get the government to actually launch the register, which is now ready to be launched. It's just basically a matter of pressing the on button. It's built and everything is sort of set to go. But also giving as wide access to the information on who are the owners of companies as possible. Ideally, we would like Norway to do like Denmark, Latvia, and other countries who are actually having fully public registers, and we still hope that that's a viable option for Norway. I just wanted also to briefly touch upon the voluntary compliance of sort of CSR approaches on corporations in Norway. On the right, you see some numbers from a KPMG study that was done on responsible taxation in the Nordic countries, and Norway is actually, if you leave out Iceland, so Norway is worst of the Nordic countries, and this is maybe a bit surprising, but I believe it's because we haven't had maybe a big event that has created a sense of urgency on why companies need to go beyond sort of legal compliance in the issues of taxation in Norway. We haven't had like big scandals and the public outcry that you've had in a lot of other countries. So this is still, I would say, more than in a lot of other countries, an issue where you see companies have this still a sort of compliance framework that you're supposed to obey by the law, but going beyond that is not necessary. It also is a high level of trust in Norway, trust in government, trust in like government systems. So the sense is that sort of the system is working, and this also means that there's less sense of urgencies to actually go beyond what the government instructs companies to do. On the left is a graph done by a study from the Norwegian Business School, looking at the 25 biggest companies on the Oslo Stock Exchange and mapping that towards GRI 207 on tax, which is the standard on voluntary responsible taxation. And companies are doing sort of 207.4 is on country by country reporting, which about a fourth of the companies are having some sort of country by country reporting. And the worst is 207.2 and 3, which is more like tax governance issues within the companies. So this is quite weak compared to a lot of other countries. Last, I wanted to, and sorry for spending too long time, maybe one of the more interesting aspects coming from Norway is the role of the Norwegian Sovereign Wealth Fund, which is one of the biggest, largest funds in the world. A huge investor in across most companies in the world. And the Norwegian Sovereign Wealth Fund has since 2017 had a expectation document on tax and transparency, which it communicates to all its 6,000 to 9,000 companies in the world that it's invested in. And it forms the basis of both its communications and dialogue with the company boards. It's also something that it measures performance of companies towards. And on the right, there's a chart seeing how well companies are performing towards the expectations of the Norwegian Sovereign Wealth Fund. And this is basically the area where the fund has the weakest performance in the mapping of the different areas that they have expectations document. You see that tax and transparency is the one where the companies are sort of mapped as doing the worst, interestingly enough. And on the left is also a chart seeing so when sort of red lines are crossed, the fund can do divestments based on a risk assessment. And so you see that over the sort of history of the fund, they've done, or since 2017, when they had this expectation document in place, the fund has done 16 divestments, basically pulled out of companies because of poor performance on tax and transparency. This includes, the expectations include things like country by country reporting, and we've seen the fund vote in favor of shareholder proposals to introduce country by country reporting in big companies. So this is also something that we work a lot on in Tax Justice Norway, is contributing to influencing the Norwegian Sovereign Wealth Fund, which is a sort of big player in the world in terms of investors. So sorry for going over time, and thanks for listening.
Thank you, Peter. Straight over to Christoph, please.
Thanks, Fairtex Mark, for the invitation. Thanks, Paul, for the ambitious introduction. I'll try to be as on the dot as you announced and to beat your on the dot perspective on the UK, looking at the German perspective. You called the UK a loser and enabler of tax dodging. The same could be said of Germany as well. I would add that Germany is back on top when it comes to corporate tax rate in Europe. So a lot of companies obviously worried about a level playing field. You won't find as much resistance to country by country reporting like you find among German companies in many other countries, I would say, in the world. So Germany in many times is a hesitant reformer, but at the same time, because of this worry for a level playing field and because of the prominent role in many international institutions, Germany is also a driver of reform. We've seen this in Pillar 2 that was strongly driven from Germany. So Germany is a loser and enabler, but Germany is also a brake and a driver at the same time when it comes to corporate tax reforms globally. I would love to have as beautiful numbers as Peter just presented on Norway, but I don't. I'd love to see them for Germany. I'm not aware they exist. Maybe soon we will have them when the fair tax mark spreads throughout Germany, and we'll see this becoming a bigger issue. But I would like to add three German perspectives to the discussion. And I don't have them on slides, so I'll try to be as structured as possible in my speech. First point, the importance of corporate tax. We've seen just last week a very interesting presentation of the EU Tax Observatory that showed us that French billionaires just pay corporate tax and nothing else, because they basically have all their income, all their savings in their corporations and don't pay any income tax and not even the French wealth tax. The situation is very similar in Germany. For our systematic analysis of the tax system in Germany, we compare tax rates of multimillionaires with the average tax rate. And you might have all heard the OECD calling Germany a high tax country with tax rates somewhere between 43% and 48% for the average German, including Social Security. We calculate the tax rate and the Social Security contributions of a multimillionaire and come to 24%. That's very similar to the number we see in France, 21, 22%. It's very similar to the tax rate you see Rishi Sunak in the UK. Rich people across the globe, but also in Germany, pay little tax. Germany is a low tax country for rich people, and the corporate tax is the only tax that remains that they actually pay. So the race to the bottom has hurt the fairness of the tax system in Germany and globally. That's the first perspective. Second point, international tax reform was very active, and we've heard some words about that already, and you all know about it. You have seen it mainly in corporate tax. And also the Tax Justice Network over many years has focused on corporate tax. We've come a long way with a two-pillar solution agreed by the OECD. We are discussing a UN tax convention at the moment. Now, at this point, we have huge debates from the German perspective where to go. Germany is one of the first countries to implement Pillar 2. It's, I mean, a German idea, so the German finance ministry should go ahead and is very optimistic that it spreads. But there's, among the business here, there's big doubts still whether China will join, whether the US will actually join, whether the US will accept a UTPR, or whether actually Germany and Europe will come out with the disadvantages being the first mover in this initiative. There's a lot of concerns among German business about bureaucracy, because from my perspective, also the OECD has failed to introduce a very simple approach to measuring tax rates. It has gone and tried to base it on the CBCR. It has tried to calculate effective tax rates uniformly across the globe, but it has landed far away from simplifying the thing and has made it much more complex. So again, as Paul already said, half full or half empty the glass. I would say we don't know yet. Actually, the miracle is still on the table. So the miracle that the US and also China and the world, actually in these times of geopolitical discontent, will come to a common agreement, even if it's not as far reaching as we wish. It's not off the table, it's still being negotiated. And it is possible that the reforms of the OECD, even if they don't go far enough, are path breaking to introduce something like a formulary apportionment that is basically part of pillar one, that the OECD reforms introduce something like a common tax base that is part of the idea behind pillar two. As I said, from the German perspective, the OECD has failed in delivering a simple solution. The OECD, from a tax justice perspective, has failed to go far enough, but it has gone and come very far when it comes to the difficult international surroundings. And maybe it has laid some stones for a solution in the long term. There's also a big discussion when it comes to international tax reform, whether this new minimum tax is actually or should be the end of anti-abuse regulations, and whether we can get rid of all the interest limitation rules and everything else, because now we have a beautiful minimum tax. I would say from Germany, we should be very careful and very hesitant. We see that real estate investors still channel investments through Luxembourg, virtually tax-free. We've looked at that in the past. It's still going on. And we argue that at some points we actually do need more anti-abuse rules rather than less. And we should first see that the minimum tax works very well before we can actually think about getting rid of some of the anti-abuse rules of the past. And that brings me to my third point, my third perspective, the special role of big business and the special role also of those businesses. Christian has presented one that want to be the leader in fair tax. First of all, I think in the current situation, their role should be not to demand bigger subsidies. The opposite is happening at the moment. At the moment, the biggest animals getting the sweetest fruits. Volkswagen gets 13 billion euros of subsidy in Canada. IBM gets 1 billion in Germany. So big companies that actually don't need additional money getting the biggest subsidies in this race for having factories allocated to your country. I think big companies should be hesitant to do exactly that. And big companies should not capture politics on their own and leave the trickle down to the small companies. That's what's happening in Germany. And I think that's what is the biggest role of the fair tax market and of the leaders of the fair tax movement to change, to give a voice to the fair taxpayers, give a voice to the small companies, against the associations basically capturing the voice of cutting tax rates and opposing ambitious reforms. And I think German businesses paying high tax across the board, we don't have as much tax abuse anymore. We had it in the past, we have much less now. We have quite strict rules. So German, as I said already, German companies having quite a high tax rate, having quite strict rules, are worried about a level playing field, and they should be actually in the right place to demand more ambitious, more courageous reforms across the board and globally. And the fair tax market should, in theory, have a very easy field day finding tax fairness leaders in Germany, even though the day-to-day convincing is actually very difficult. And I know about that. But as I said, we have a lot of potential here in Germany, a lot of companies that do pay high tax whether they want or not. I think, and complaining about the reforms, the bureaucracy, I think they should be more courageous, lead the way towards simpler solutions, towards formulary apportionment, and towards a common tax base, and towards a high minimum tax, fair tax payments across the board and globally. And last, I would add a special role of big business. Now in the crisis, we have seen that big businesses have increased their profit margin, often at the cost of smaller businesses that can't set prices. I think we should globally also start discussing about a different system of taxation for big companies. We already have it. Anyone above 750 has to do CBCR. Anyone above 750 of revenue has to pay a minimum tax. And everyone above 20 billion euros has to pay or have to pay their tax at a different place according to pillar one when it comes in place. I think big companies with returns that go beyond 10%, and there are not too many of them, that have a strong brand that can set prices in their markets, they should actually get to pay higher taxes than everyone else. So we can cut the tax rates for the small businesses that struggle in the crisis. We should tax those extremely profitable and huge companies at a higher rate than we do for the smaller ones.
Thank you, Christoph. And you did deliver, and then some. You covered a lot of ground there in 9 minutes. I would just add before I hand over to Lorena, that we do actually have a fair tax med accredited business in Germany called Unite. It is going head to head with Amazon, both in operationally and also in terms of responsible tax conduct. This business willingly and freely actually produces a public country by country report, unlike Amazon. So it exists, it's there, and it's championing the way. Straight over to Lorena. Thank you.
Thank you, Paul. Just 1 second to share my screen, and I will be starting. So thank you first of all for having me with you today. I will also open up the slides. I hope you can all see them in presentation mode. So thank you for having me today. I'm happy to join this distinguished group of speakers, and with my presentation I hope I can complement some of the elements that we just heard from a national perspective, also with the view from Europe and from the work that CSR Europe, that is a European umbrella association, is doing in relation to how to help companies advancing on responsible and transparent tax behavior. So my presentation in the next 9 minutes will be structured as follows, with a quickly brief info on CSR Europe, and then indeed an overview of how we're approaching this topic, what we are doing, and what are some elements and trends that we see also interacting with companies and also in relation to the way forward. So very quickly, with CSR Europe, we are a European business network for corporate sustainability and responsibility. And our members are both corporate members that you see on the left-hand side of the slides, as well as national partner organizations, so sustainability networks that act also at a local level. And together we reach over 10,000 companies in Europe and a bit beyond, also thanks to a number of international partners, as well as a number of other stakeholders that we interact with, which are from policy making, from civil society, to, of course, organizations like Fair Tax Foundation. And the way we work with companies when it comes to sustainability, we want to help them with the foundation, first of all, about that, on how to mainstream and better integrate it inside their company, as well as facilitate opportunities to exchange, peer-to-peer learning, but also really practical collaborative actions. And on tax, I will tell you a bit more about what we are doing on that. And also we try to trigger and facilitate systemic change through our close relationship with the EU institution, not only because we want to advocate for a better role of business in the delivery of the EU sustainability agenda goals, but also provide the companies with the needed intelligence on how to adapt to all of these requirements that are currently coming onto business when it comes to EU legislation on sustainability. And our work is divided in 3 different areas: people, materials, and markets. And the work that we do on tax is falling under the bigger agenda on ESG reporting and transparency, as well as sustainable finance. But let's say why a sustainability network is working on tax and sustainability. So the reason is, since we started, let's say, to approach this topic, we really think that tax should get recognized as a fundamental component of CSR. And that is how we try to raise awareness within companies about the importance of integrating responsible taxation into the narrative about sustainability. This is because, of course, at the general level, tax, as we all know, are extremely important tools and leverage to deliver on the bigger objectives that we have at international level on sustainability with the SDGs, but also at European level with the European Green Deal. But also when it comes to businesses, of course, tax give information on what is actually the impact that companies have on society. They represent a significant economic contribution to local economies, so that government have the resources to invest in healthcare, in infrastructure, in the welfare of the population. And of course, the attention also to this topic topic in the overall and bigger picture of sustainability also comes from the increased attention that this topic since 5, 6, 7 years is having from different groups, not only civil society following the scandals that we all know about, but also policymakers, not only at international level with all the OECD and the BEPS, but also at EU level with all the attention, not only on public country by country reporting, but also on other measures that they have been put in place. And so we really see the benefit for companies to engage on this topic, not only to really create a consistent approach with their sustainability strategy, but also really to ensure to build the trust that also Christian was mentioning before with stakeholders, including governments, of course, to ensure good reputation, to also be able to manage and anticipate risks as well as costs linked, for instance, to the adaptation cost to new legislation, and of course also try to align better with the needs and expectations of stakeholders like investors, which are more and more interested in investing actually in companies that are able to provide this kind of information also when it comes to the tax performance of the company. And CSR Europe has started to work on that since 2016, and we have put in place a number of activities, which include, let's say, and I will mention only one, in the interest of time, in 2019, the launch of a blueprint for responsible and transparent corporate tax behavior that we launched together with PwC Netherlands and featured the contribution and best practices of a number of front-runner companies on this topic. You see them on the slide, that provided really practical insights to share with companies at different stages, let's say, on this journey towards becoming more responsible and transparent on tax, to really, and in premise, facilitate the cooperation between tax and sustainability department, which we think are very important actors when it comes to advancing these agendas for companies that need really to break the silos and collaborate together. So this work was also there to help managers to embed the tax into the sustainability strategy, as well as support tax managers to align actually the tax policy with the strategic priorities on sustainability. And recently with Fair Tax Mark also we have started a new work, a collaborative platform on tax responsibility and transparency launched last January, where also, since our engagement with a number of companies that are quite mature on this topic, we realized that even if in the last years there's been a plethora of instruments and frameworks that the companies can look at to guide a bit the shaping of their tax policies, but also the reporting exercise. First of all, companies were having some challenges in navigating all of these frameworks, but also were a bit struggling when it would come to the measurement of their performance, the monitoring also of the progress over time, and the benchmark with their peers. So the works that we have been engaging in is in the creation of a toolkit and an index that could help to reach these objectives. So to really help companies assessing their performance, and also being able to communicate better about this performance with the stakeholders. And the idea here is not to develop a new set of metrics, but on the contrary, develop a synopsis, a summary of what are already existing resources, and then collate them in the form of an index. And in this work, we have a number of supporting companies, including some fair tax certified companies like Ørsted and Vattenfall, of course, our co-partner, as well as some knowledge partners, EBTF and MPRI. And the project is structured along these steps, which included, of course, as a first very intensive step to start to map and research about all the existing sources around responsible and transparent tax behavior. And now we are deep dive into step 2, where we are organizing a number of focus groups, where we are also inviting stakeholders to participate from different groups and organizations, civil society, policymakers, and others, also to test these draft metrics, see if they make sense, if we missed something, and then start the piloting and validation phase to ideally share and launch this index at the end of the year, also with a high-level event here in Brussels. And just on the previous step that we concluded a few weeks ago, of course, the mapping of what is out there was quite intense. There is actually a lot that could help already companies that are at the beginning of this journey to start to understand what are the basics, and these resources come from different groups, from civil society to investors to rating agencies. And what we did is also to try then to cluster them according to 6 areas that we think represent the building blocks of a responsible and transparent tax behavior. So starting from tax policy and strategy to tax function management, of course, not forgetting about the transparency and reporting, but also including some other elements like the interaction with the stakeholders or responsible advocacy. And happy also to share more information about it at a later stage, also on individual basis with all of you. So in terms of trends and expectation that we see, also to conclude my my intervention, also with the bigger picture at European level, of course, the stricter requirements that also the EU is putting in place around tax, it involves also legislation related to companies, is very important to notice and to highlight. There are, of course, a number of initiatives that deserve more attention. Of course, the public country-by-country reporting directive, DAC 6, as well as other kind of initiatives like the EU Code of Conduct on Business Taxation, as well as the BFIT framework. But also, as I mentioned before, I think an important trend is also this increasing attention from investors that companies should be aware of and try to understand really what are the expectations, what they would like to see in terms of information from companies, both in terms of the commitment around the tax policy, the governance, and of course, the data per se when it comes to basic information per jurisdiction. And this goes also along the way of expectations that come also from rating agencies when it comes to common interest in information they would like to see and be able to gather, like in terms of policy, risk control and governance around tax, as well as specific focuses on areas like the narrative that we also think is an area where companies still need to progress when it comes to accompany the tax data with a narrative that could give more information around the context, being it explaining the presence in tax havens or in relation, for instance, to tax controversy. So to close the way forward, of course, I think there are some elements that are worth noting in terms of how much anyway tax and sustainability have come closer in the last years, in terms of maybe people realizing that are part of the same bigger agenda and objectives. And positively, we see this increased interest from investors, civil society and policymakers as a push for companies to become better in disclosing, but per se also better in the performance and becoming more responsible on how they shape their tax system and structures. But of course, there are still a lot of challenges because tax and sustainability are not yet there at the level of being considered part of being on an equal footing, both in terms of the EU policy frameworks, where actually we missed the opportunity to really integrate tax into the EU policy framework on sustainability, because maybe some of you know, but we have a new corporate sustainability reporting directive on sustainability, whereby tax is not included among the ESG topics that the companies should disclose information about. And this is a missed opportunity in the sense that, of course, EU is doing a lot around tax, but still they don't consider then yet tax as part of the same agenda, but also within companies, because the journey towards getting closer to the sustainability and the tax department is still quite long, also in relation on how to consider the tax function per se within companies, not only as a minimizing costs, but really as a function that should have also this responsibility role of shaping the tax policy in a more fair and responsible way. And also the communication with stakeholders, the engagement with stakeholders, which should be enhanced, strengthened, not only at the level of integrating expectations and concern at the beginning when preparing the tax approach and strategy, but also on an ongoing basis, like we see in relation to other ESG topics. So very positive developments in the last year, but a lot of work still to be done. So I will close it here, and thank you very much for the attention.
Thank you, Lorena. I thought I spoke fast, but you have challenged me on that one. So we've got 6 minutes left. There's a question specifically on Germany, which I'm going to ask Christoph to pick up in a second. Anything that's been put to Fair Tax Foundation, we're answering in the text body to save some time. And I'm going to put one of the question first, though, to the others, which is we've got the responsible tax community over here, and we've got the climate change, progressives, renewables over here. How much do they actually talk, and how do we get tax to actually drive a zero carbon economy as opposed to pulling a completely different direction? I'll start with Christian and then ask Christoph and Lorraine if they want to say anything very quick, and then we can end with, and Peter, and then we can end with Christoph picking up the Germany question, please. So over to Christian.
I'll be brief, Paul, I promise, although it's a topic I could speak to for a while. But I don't see an inherent conflict in responsible tax and the transition to net zero and the sort of ask and demands from that industry. I am aligned with Christoph that I don't think necessarily profitable companies should be asking for a bunch of subsidies. If you're making money and you're running a profitable business, then probably you're not in need of subsidies to run that business. And renewable energy as a starting point is a profitable business these days. We are a testament to that. I think there are some particularities around our business that probably warrants a fair look at what the tax systems offer today. We are an extremely capital intensive industry. We commit billions of euros to construct an offshore wind farm. Naturally, the business model is we want to invest in new wind farms continuously. If we tie up all of that capital in an already operational wind farm, we are unable to continuously invest in new wind farms. So there are matters such as accelerated tax depreciation or capital allowances on wind farms where I think you could arguably say, is it not in everyone's interest that we recoup our investment before we start paying tax on the profits? But that's a timing question, not a question of the nominal amount of tax to be paid. I think there's certainly a discussion to be had on that, and a continuous discussion on that. But as a starting point, I think our business model relies on well-working societies. We need well-working power grids. We need well-educated people in order to run our business. We need stable governments. All of that is funded through tax payments. So it would be an odd ask on our part to say that our business should not contribute to those working societies, because at the end of the day, that is unsustainable and would also be destructive and disruptive to our own business. So at least from our point of view, I can clearly say I don't see a conflict. I rather see responsible tax and the transition to net zero being complementary to each other.
Okay. Peter, Lorena, if you could just give us a 30-second perspective, and then we can end with Christoph and the question on Germany.
I do feel that if you take the sort of the huge undertaking that is meeting the climate goal seriously, we need to be pricing emissions, for instance, so much higher. And I do feel like the tax community, we have a focus on sort of equitable outcomes of existing taxation. But actually moving as quick as we need to do on climate and pricing of carbon emissions, for instance, at the same time as ensuring equitable outcomes, who actually are taxed. That's a very big challenge that I don't see sort of the NGO community being sort of completely rigged to talk together in the speed that we need to do. So yeah, it's a huge challenge.
Thank you. Lorena?
Yes, just quickly, maybe to echo already what was said, I think they need to talk more to each other. I mean, echoing a bit what Christian said at the beginning, I also don't see any conflict, but more a complementarity with the two agendas that need to go hand in hand, and maybe tax is a lever and an instrument to deliver faster and better on the ambitions around the green transition.
And I would just add, we fully support the polluter pays principle, and proceeds from that could be directed towards the needs of decarbonizing our economy. So there's no conflict there from our perspective.
Great. And so end with you, Christoph. Address either or both of the questions, please.
The first question, I think the German climate movement has just in the last months recognized that they need equitable solutions. Otherwise, the fear of people of losing out is just too big to get anywhere in climate. So we are on a good path. We haven't reached the goal yet of combining the two movements, but the realization that is necessary is there. Concerning public concern around tax avoidance, it's been a huge topic in the election campaign 2021. Even the business-friendly low-tax party, the FDP, wants to tax Apple higher. That's how they translate tax justice, tax those big corporations, digital corporations higher. We had a discussion about CBCR, and the business lobby said people still buy iPhones despite their tax avoidance, so they don't care about it. And I think those two poles meet in the middle, and the truth lies between those two. German companies do feel the pressure, mainly from the investors, mainly from their peers, mainly from journalists asking questions. They feel the pressure to be behaving better than they did 10 or 20 years ago. The pressure hasn't arrived at the Apple cash point. So the customer so the attraction of the iPhone is still higher than the disincentive of Apple not having the fair tax mark. So there's still some way to go for the fair tax mark, but the pressure is already rising, and companies do feel it in Germany as well.
Right. Thank you so much for all those speeches, straight to the point. Just so the audience knows, all of the webinars which have been recorded will be available on YouTube next week. And if you keep an eye on the hashtag Fair Tax Week, there'll be other things developing which you can tag into. Thank you everyone for joining us, and thank you for all the speakers for a wonderful event. Bye everybody.
Thank you.
Thank you.
Thanks.